Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Wednesday, the 18th of January. I'm Daniel Lam, your host for the podcast. Last week, Standard Chartered held a well-attended Global Market Outlook webinar, where there was a fireside chat with Mark Carney. He was the former governor for the Bank of England, as well as the former governor for the Bank of Canada. I had the honor of being the translator from English into Cantonese for this event, and I must say, I learned a great deal more than I imagined from his contents. One of the key points he made was that we have gone from a world that is focused upon efficiency to become a world that is centered around resilience. This has major implications on how you should be positioning your portfolio in the long term. So let me elaborate. In the 30 years since the fall of the Berlin Wall in 1989, there was global integration, including China entering the WTO in 2001. There was liberalization and convergence of economic policies. All these forces increased efficiency globally, but there was relatively too little demand for that. So inflation was consistently below target, and interest rates was trending down in those 30 years. Now, fast forward 30 years, a few factors have moved us out of the world of too little demand to having issues with supply. First of all, in the short term, there was the energy shock from the Russia-Ukraine war. Over the medium term, you got the transition in the energy sector, as well as the COVID-19 aftermath. And finally, for the longer term, you have supply chain disruption. It has become dangerous for companies to have one single line of supply because of factors like the weather, COVID shock, and of course, geopolitics. Thus, the world needs to spend money to build resilience, for example, on healthcare, defense, invest in climate transition. These are cost or insurance premium, as Mark put it. All these costs mean slightly higher resting interest rate and volatility in inflation. Now, let us go back to what it means for your portfolio. If you look at the VIX, i.e. the S&P 500 Volatility Index, you would notice that since 2020, the 20 level had become the new floor, while VIX was very frequently hovering around the 10 level before 2020. So this environment of higher volatility and higher rates means that it is very important for investors to have portfolio diversifiers, for example, alternative or private assets that are relatively uncorrelated to the traditional equities and bonds. Now, this echoes with the E in our SAFE theme for 2023, i.e. expand beyond the traditionals. Now, in such alternative or private assets, you want to have those that have stable cash flows and the ability to transfer the rising costs to the consumers such that you can fight the higher level of rates and inflation. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.